All right, welcome back to accounting. This is chapter 3, looking at transactions. Okay, first off, so we were talking about building a list of accounts. So typically, this is what a chart of accounts will look like, right? It will be in order based on account type. So that means all your assets are going to go first, then your liabilities, then your equity, then your income, and then your expenses. Okay? Why is it in this particular order? In this case, it's just what it is. Okay, it's just an easier way to just be able to locate your assets and to locate your liabilities and to locate your expenses much more easier, right? And we talked about putting it in the order based on category. So at that point, right, that is where we are, when we create our list, right, we're putting it in order by account type and we're putting it in order by account category. Now, again, what is the purpose of using a chart of accounts? This is a list of all the accounts that are usually used in the process of journalizing a transaction or recording an event. You need to have these accounts existing before going ahead and journalizing. Okay? So in this case, right now, the accountant is going to be the most important person because they're going to be creating these accounts. Okay? All right, so they're going to be creating the chart of accounts, so then the bookkeeper can go ahead and use this chart of accounts to be able to determine the where to put the numbers according to where they need to put it, right? So in this case, that's exactly what we're going to do, okay? You're going to be using your chart of accounts to be able to determine how a transaction is going to be organized. Now, for an accountant's perspective, it is not set in stone your chart of accounts, okay? Your chart of accounts can be ongoing. It can be added. You can add an account at any given time as long as it makes sense and it represents the transaction that you're trying to record. If it doesn't, if there's already an account that exists, then you're just going to have to either figure a way to either use that account or make sure you double check your chart of accounts if there is a similar account that already exists. Okay, so again, for any reasons that you have to continue to keep building your chart of accounts, it is possible. All right, so let's talk about the general journal. Okay, so this is what the general journal will look like, right? You'll have your transactions here, right? You have the situation here. You have the description. You have the date that it's been recorded. You have the account numbers and the associated dollar, okay? So what is the purpose of the general journal? Well, it's a book where you record your daily business transactions, okay? Now let's start about how we actually journalize our transactions. We got to start, number one, by putting our transactions in chronological order, right? That's the first thing that you want to do, is that every transaction that you journalize, it's going to be recording daily transactions, right? Like any journal, right? If you're doing one day at a time, then it's going to go in chronological order, okay? And then the second step is going to be determining the accounts. Now, how do we place our accounts into our journal? Well, when we look at a business transaction, for instance, the second one, right, where the arrows are, we made a payment for rent, okay? And the rent landlord expected us to pay a month in advance. And how did we pay for it? We paid using our checking account, right? We wrote them a check, okay? Now, in this case, right, that is what the transaction is that we need to put it in a specific order. Your debits are typically going to go first, okay? And those debits are usually left aligned. You can tell if it's a credit because you're going to indent your credit account, and here it is, your checking account. Okay? Now, how do we understand this? Well, in this case, right, when we're making a payment to rent, right, and we're using cash to pay for it, right, now we got to break it down. We just paid for rent. Rent is going to be considered an expense that we have to incur for the business. So I am increasing it, right, because I bought rent. And then now your checking account, right, you had to spend the money in order to pay for the rent. So therefore, the checking account is going to be decreasing for the amount right here. All right, and that's how you determine, right? Because checking is an asset. How do you decrease an asset? With a credit. So that's how you're going to determine it. Right? Then the third step is going to be using your post reference. Now, it really depends if you choose to do so on your chart of accounts. Do you have a designated account number? If you do, then that's exactly where this post reference is going to refer to. Post reference meaning, well, in this case, right, what account am I linking this to? Okay, so in this case, right, checking, if you go back to your chart of accounts, checking is 10100. Okay, so therefore, that's how I determine my checking account right here. So the checking, okay, cash, and then we had furniture, and we had prepaid accounts and a rent expense. Okay, so again, those are where the numbers come from, is going to be from your chart of accounts if you use account numbers. Now, strictly for account numbers, it's definitely much more easier to memorize a 5-digit code than it is to memorize a bunch of words, right? So in this case, you might be using more the accounting number more often than you would refer to the actual account itself, okay? But that's okay. As long as you have your chart of accounts, you're able to make a reference at any given time, okay? And then now is going to be determining how we set the money into each and every single account. Now, the rule here, which we'll talk about in chapter 4, is that the rule is that when you record your transactions, right? A business transaction is when, money is being transferred, okay? So how we record that? Now, in this case, my rent is $500, but they made me pay for a total of 3 months worth of rent. That means I had to pay 2 extra months for rent. So in this case, that's why it's being split up. But at the end of the day, I end up paying a grand total of $1,500. So this is where I have to understand this. I had to pay 2 months in advance for rent, and I had to pay for the month of January's rent. So therefore, that's why you're utilizing your numbers and you're splitting them in a specific way. But at the end of the day, right, this is the amount of money that you spend, and this is the category, or these are the accounts that you designated to sort your information in. And guess what? Rule here is your debits will equal your total credits. Okay? Right? You got your $1,500 credit, and you have your equal and opposite debit of a total of $1,500. Okay? So that's how we journalize our transactions. Okay? And of course, your description. Obviously, your description in your journal isn't going to be just strictly only account names, okay? It's also going to hold details in regards to the transaction itself, right? For example, right, in this case, I just put rent expense, prepaid rent, and a checking account. How is that going to tell me what has happened? In this case, I can make a note as long as it's in parentheses, right? It could be italicized, it could be capitalized, it could be any type of font that you want. As long as it's in parentheses is what matters, Okay, so you can put as much detail as you'd like in your journal, just so then you know what has happened here. So in this case, I paid for rent for 3 months and I used a check as proof that I paid, check number 1501. That is going to give me enough details to what this transaction is about. So that's the last thing is there is you're going to create a description, because again, you may not be the only person that's looking at the journals, right? You can have an advisor look at your journals, and if their journals is blank, right, then the other person who's reading your journals isn't going to make any sense of this. They don't know what the transaction you're recording. That's why it's important that even if you don't necessarily want to have it, right, it's good to have a description so you know exactly what has happened on this day, right? Especially if you are like a day-to-day person, right? Sometimes it's hard to even remember what you did this afternoon, right? So how do you expect you to go through a whole entire month's worth of transactions and being able to recall what each and every transaction was about without having some kind of description, right? That's how you do a journal, okay? Any questions there? Okay, we will practice doing our journals today in the exercise. Yes.
So I know you spread the 3 months lane in two ways, because you want to, or because you are following the rules that we're gonna learn.
In this case, right? In this case, it's in this case, right? When you're referring to rent expense, right? You're working in the current accounting period. So in this case, when I'm making a payment for rent, I'm paying for just January. Make sense?
Yes.
But in this case, because the landlord said, hey, no, I don't do month-to-month transactions. I do 3 months at a time. Okay. So in this case, right, that means I paid in advance 2 months. That means I already have January. I'm paying for February and March. That's going to be considered a prepaid account because I'm paying my vendor ahead of time.
Yes.
So that means I own the rent for February and March. But right now, in the current accounting period, right now I'm only on January. I'm only making a payment for the current expenses usually happen for the current period. So in this case, I'm going to make a payment for January for now. But in this case, I made a payment for all 3 months.
Okay.
That's how I understand this transaction. Now it's up to you. If you choose that you are going to be doing an accounting period where it is a quarterly basis, then you don't need this prepaid account, because you could just say I paid rent for 3 months.
Okay.
Okay? So it just really depends on your accounting period.
Okay. Thank you.
All right, any other questions? Okay. So transaction analysis, okay? There are 7 steps to transaction analysis, okay? So with these 7 steps is basically how you're going to determine when to journalize a transaction, okay? So step number 1, right? So step 1, we need to be able to recognize that a transaction has happened. And how are we to do so? Well, in this case, here's a proof of a receipt, right? How is this going to be determined a business transaction? How would this affect my business is what your first step to do is, okay? You need to recognize that a transaction has occurred and how does this affect your business, right? In this case, I purchased from a random company, and I end up purchasing a table, chairs, and a couch, right? I bought furniture. Now, is this a personal transaction? Did I buy it for my own home, or did I actually intentionally bought this for the business? If I bought it for the business, then already right there, I spent money for the business. Okay? So that's the first thing you gotta do is you gotta recognize that a transaction has happened. Okay? And how does it affect your business? Okay? So that's where step 2 is we need to analyze. We need to understand what has happened. So that's why proof of a transaction is crucial, right? Having a receipt, having an invoice, having a physical copy that something has happened, that transfer of money has gone through. And you need to analyze it. So in this case, right, we did take a look at the receipt, right? We end up buying furniture for our store. Okay, so that is analyzing and understanding what the transaction is about and how it affected my business. Well, that means my business, right, has furniture now. Okay? So then step 3 is going to be determining what accounts are actually being affected. Well, in this case, I purchased some fixed assets, right? That's what furniture is, right? How did I pay for it? Well, it looks like I paid with cash, right? Your receipt will always tell you how you paid, right? It will tell me right here that I paid with cash. So therefore, those are the accounts that are being affected. Now, you need to determine, is it increasing or is it decreasing? So that's where, okay, well, I just purchased furniture. Does that mean I gained furniture? Did I increase my furniture? Yes, I did. I gained a table, I gained a couch, I gained some chairs, right? But how did I do that? Well, I had to spend my money. So in this case, that means I had to decrease my cash, okay? And then step 4 is going to be looking at the company's chart of accounts. Do you have those accounts that you just listed out? Well, I have my checking account, right? That's my bank account, right? And I use cash, right? I paid with cash. Next thing I have here is I do have a furniture account. It's a fixed asset of mine. So in this case, I determined that I do have these accounts in my chart of accounts. So that means next step is going to be utilizing the debit and credit system, okay? Now, here's what we do, right? How do we determine using the debits and credit system? Well, that's what the accounting model is going to do to help you, right? In this case, I spent money. Money is an asset. And did I increase or did I decrease my asset? In this case, I spent my money. It's gone. It left my hands. So in this case, I'm decreasing my cash flow, right? So there you go. I determined it's decreasing. And how do I decrease an asset? With a credit, okay? But on the other hand, right, I end up buying furniture. So my furniture, which is a fixed asset, right, since I increased my fixed asset, right, that means I must have debited my account. So right there, I know exactly what I did. I have a debit for my furniture and I have a credit to my cash account, okay? So the next thing you're going to do is you're going to determine which book you're going to be recording this transaction in. Now in this case, depending on the business, right, you can't have a separate book for sales, a separate book for purchases, a separate book for fixed assets, and so on and so forth, right? For this class, since we're learning from the very basics, we are only going to be utilizing one book, and that's just going to be called the General Journal. So you're going to record everything in there, okay? There's no specific book, transaction book that we are necessarily going to be learning, but every company is different. If they do have it, then you need to determine which book you're going to actually be putting that transaction in. In our case, only the General Journal is what we're going to be looking at. And then last step here is do it, right? Using the rules on how to journalize a transaction, we already determined furniture is going to be debited. So that's why my furniture account is first. And because I use the chart of accounts, that's my account number. And how much did I pay for it? I used my receipt. I paid $500 for it. How did I pay for it? Well, there's my credit account, which is my checking, which is my cash account because I spent the money. How much did I spend? $500. And boom. My description is I just purchased furniture for the shop. Okay? And my total debits equal my total credits. Okay? All right. So this now, that is the 7 steps of transaction analysis. Any questions there? Okay. No questions? Okay. What about correcting entries? Okay. Now, the rule of thumb here is when you are journalizing a transaction, you have to be very careful when you are entering a transaction and it could potentially be wrong. Okay. Again, because we're beginners, this is where it's your time to make mistakes and to learn from them, right? And especially with programs such as Excel or QuickBooks, right? Because it's a program, we're able to override it, right? We're able to delete it. We're able to re-enter it, right? But in this kind of context, when we do remove a specific transaction and we re-enter it, we do come into problems where we have a possibility of making more errors. Now, in this case, for the sake of this class, we are looking into practicing this, but the rule here is that because the reason why if you make a mistake, you shouldn't be deleting it is because that's room for potential fraud. Okay? So in this kind of case, right, if it's a potential for fraud, then that's why you can't just cross it out. You can't just delete it off of your books because you think you can, right? You have to be very careful because this is a company's means of spending the money, and you want to be very careful because you don't want to be liable for that error. So in this case, how do I correct them? I have 2 different methods. I have the reverse and re-entry method, and I have the error cancellation method. Okay? So in this case, right, let's go ahead and dive into the first one, which is the reverse and re-entry method. Okay? So for instance, right, on September 15, you decided to purchase some office supplies with cash in the amount of $65, right? Sales taxes included. And of course, you recorded this transaction as $56, okay? Correct this entry. Now in this case, right, maybe you bought the office supplies and it's late in the day, and then the next morning you come across and you're like, oh, I made a typo, right? The 5 and the 6 are pretty close, right? You might have been journalizing this way too quick, so you accidentally wrote that you actually had purchased $56 worth of supplies and you spent $56 worth of cash. Now, in this case, right, that's not true because your receipt tells you that you spent $65. So in this case, how am I able to use the reverse and re-entry method to correct this entry? Well, let's break down the steps. Let's first reverse it. Okay? So in this case, right, if you're looking in a real life situation, right? You went to the store, you bought some office supplies. How do I reverse that transaction? You go to the store, you return the items, and you get your money back, right? That's the same essential idea, right? We're going to reverse the entry by going to the store, returning the supplies, and getting my cash back, right? And returning the product, right? And then, next step I'm going to do is I'm going to re-enter it. So I'm going to rebuy those supplies, but I'm going to rebuy it and enter in the correct amount. So what you're essentially doing is when you reverse the transaction, you're voiding it, right? Right? You're undoing the transaction by saying, I purchased office supplies for $56. Well, I'm going to reverse it. So I'm going to get that money back and then I'm going to re-enter it in by repurchasing it for $65, which is the correct amount. Okay? This is a more common way so you don't prevent yourself from making any more mistakes after that. Okay? Because the best way to do is just zero it out and then re-enter it in for the correct amount. That way, you're a little more on the safer side. Okay? Now, for those of you who have been doing bookkeeping for a long time, error cancellation might be something that is much more easier for you to understand. However, this also can cause potential mistakes, right? Because you might accidentally place an amount in the wrong account when you're trying to fix this error, right? So the error cancellation method, what it does is it literally takes the amount that you recorded incorrectly and it makes you compare to the correct amount, right? So in this case, right, I recorded my office supplies at 56 when in reality I purchased it for 65. So that's what I need to do. I need to compare and contrast the difference between the two. And the difference is $9, okay? So we figured out that it's $9. Now, here's the difficult part. You have to understand which account is either under or over by $9, okay? So let's take a look, right? Office supplies, right? Am I short $9 or am I over $9? Okay? Am I short in $9 cash or do I have too much cash? Okay? That's what you have to do. Now, in this case, for people who have done this many, many, many times, they can understand it and be able to determine what it is right away. But this can also be very confusing for beginners because it's kind of like, well, I don't know. I have to go from $56 of supplies to 65. So where am I going to be adding that $9 or subtracting? In this case, I recorded 56. I need that account to be 65. So that means I must be adding more $9 to the office supplies, okay? And then, of course, in my pocket, I'm supposed to have X amount of dollars. I have less. So therefore, you can determine by looking so that I must have spent $9 more of my cash because I looked at my wallet and there's missing money. So that's another way that you could determine it that way as well. But this is more difficult to be able to do this. But again, it can be done, right? But again, what if I put cash first and then I put office supplies next? Then I created another error upon correcting an error from my previous mistake. Okay, so again, for avid users, this might be easier. Okay, for beginner users, this might be difficult. However, rule of thumb, both entries are correct. Okay, now, can you do both at the same time? No, you can only choose one method to use, okay? Yes, you can swap between the two, but at the end of the day, you need to, if you made one mistake, you can only use one correcting journal to fix it. You can't use both, okay? Any questions there? All right. I guess not. So let's talk about yes.
So if we want to switch, we shouldn't switch the method in the middle of the accounting period. It would be a good idea.
For this one, because it's a correcting journal entry, it doesn't matter which method you use.
Yes.
So this one does not really affect your accounting period because you're just fixing the journal entry. So it doesn't matter which method that you choose to do, right? When we talk more into in chapter 4, that's where the methods that we choose, yes, we should tend to stick to them for reasons being because if it results in different outcomes, then yes, you should definitely stick to one method. But in this case, it doesn't matter because at the end of the day, the goal is the same.
Yeah.
Right? You're correcting a mistake that you did. It doesn't matter how you get there.
Okay.
Okay? So in this
Alright.
one, it doesn't matter whether you switch between the two.
Okay.
Okay?
Thank you.
All right, so let's talk about T accounts. Now, T accounts is just a quick summary of if you've been using account too many times, right, in your journal, you can go ahead and draw a line here and be able to, get a quick overview of what your account balance is. Okay? Now, again, you can do this, or the best way to do it is through the general ledger. But in this case, right, your journal doesn't tell you your account balance, right? Because this book is just strictly for daily business transactions. All you're doing is recording, and recording. Okay? The daily business transactions. You're not in any means of using this for account balance. Okay? So then you're able to create T accounts to be able to get a quick overview of how much your account balance is. But that's not really necessary unless you are just trying to do quick, on the side. You just want to know where you're at right now. That is completely fine. But there is an actual book that allows you to be able to recognize your account balances at any given point in time. And that's where we're going to talk about the general ledger. Okay? The general ledger is a book that has a list of every single account with its respective account balances. Okay? Now let's take a look at the difference between the journal and the ledger, right? It's almost identical. The only difference is you have an extra 2 columns and it's giving you a running balance. So let's take a look at this one, right? On August 31st, right, you had a transaction where you increased your checking account by $150. So now you have $5,124 even. Okay, so you must have started out with something. And then next thing you hear on September 1st, you have an increase for $154. So again, that's referring to the transaction here that I had a sale, I had to pay for rent. Okay, so there you go, $154. Since it's a debit, I increased my cash account. Therefore, I have a new running balance, right? Because I added that $154. So that means now I have $5,278 in my cash account right now. Okay? But then on September 2nd, I end up having to pay rent for $500. So that means that's going to decrease my account by $500. So the general ledger, the purpose of the general ledger is to record those exact same transactions from your journal, but in this case, right, it gives you your account balance at any given point in time. Okay? Because once you finish recording the journal and you post it into the ledger, you're going to have a constant flow of a running balance to let you know how much money you have left in each account. Okay? And that's why for most accountings, right, the easiest one to keep track of is your checking account because you're constantly depositing money into it and you're constantly writing checks, which decreases your checking account. But why stop at just the checking account when you can do it to all of your accounts? Okay? And that is going to be a very important step, which we'll talk about in chapter 4, why it is necessary for us to even gather all of that information to to get an account balance for every single account. Okay? All right. So, course review, we talked about what the chart of accounts does, right? It's a list of all the accounts that exist for you to be able to record your daily business transactions. We record those daily business transactions in our general journal, which will look like this, okay? where you have the account names, the date, the account number, the amount of money that was spent, okay, or transfer in terms of dollars, okay, and of course we also have the description, okay, and our debits equal our credits. Down below is our correcting entries, right? If for any reason that we made a mistake in our journal, this is how we would be able to fix it, right? We would fix it by doing the reverse and reentry, or we could do the error cancellation. T accounts just gives us a really an overall sum of the money. And last but not least, we talked about the general ledger, the difference between the ledger and the journal. They both are identical, right? They record the business transaction. However, the only difference is your ledger gives you your account balance, while your journal doesn't do that. Okay? All right. So, any questions for chapter 3?
Yeah, I just wanted to know, could you would you possibly just go over like the whatchamacallit, the like exactly the like the first part of it, just how like the general journal is, like if you just go over that briefly again.
Sure. Like how to properly journalize, right? How to create the
Right.
journal in
Yes.
the first place.
Yes.
Okay. Okay, we'll go over this real quick. So this is what a typical manual bookkeeping journal should look like, right? It will be standard on a spreadsheet, or in this case, it's actually written in a note journal book. Okay? And then there's columns that you need to recognize, right? You got the date, you got the description, you got the PR, you got the debits, and you got the credits column, right? Hence why debit is left and credit is right. Okay? Now, how do we properly journalize? Well, this is what I do. Step 1, you have to do it in chronological order. That means date has to be in order. Okay? Because if this book is for daily transactions, right? If you're recording on a day-to-day basis, well, then you're going to record the date first. Okay? Then the next step is to go ahead and take your transactions, go through the transaction analysis to be able to determine your debits and your credits. Once you figure that out, the rule here for journalizing is your debits must always be recorded first. Okay? And usually they're left aligned. Okay? And then your credits are recorded afterwards, or last in this case, right? Because, and then what we notice is that how do you make a difference between their debit and the credit account? We indent the credit account. Okay? Then the next step is going to be looking at the post reference. Where does this post reference number come from? It comes from your chart of accounts. Okay? Now, that's if you use a designated account number. Now, your account number could be a 5 serial number. It could be A301, right, for assets, right? And your liabilities could be your L300s. Any kind of code that you want to use to be able to determine your chart of accounts is up to you. Okay? In this case, in this case, it's much easier to memorize a 5-digit code than it is to memorize words. So in this case, we already have it laid out for my chart of accounts is that my cash account is account number 10101. So therefore, that is why on my account, for every time I use cash, it's account 101. Okay? Then the next step is going to be filling out your debits and credits. Well, how do I do that? It's going to be in terms of dollars, right? Where how much money did you spend? In this case, for my checking account, right? I spent a total of $1,500. Now, how do I split that up? If that's how much money I spent, right? So that means I have to credit my account for $1,500. Now, where am I going to put my debits? Well, I would have to figure out, am I paying for all 3 months? Is this a rent advance payment? Am I paying for the current month? And that's what exactly I did here, right? My rent expense is for the current month of January. Well, that means I had to pay a total of 3 months because that's what my landlord said. My landlord said I can only contract for renting out my property for every 3 months. So in this case, that means I paid for February and March in advance, and we call that a prepaid account or prepaid rent, right? You bought rent in advance. So in this case, if I paid a total of $1,500, right? I just think about it, right? It's going to be written on your contract how much it is per month. So in this case, it's $500 per month. So that means I'm going to pay for January, and that means I paid for 2 months in advance, which split up my debits and credits. So that's what you have to do. And at the end of the day, your total debits equal your total credits. Okay? And then, of course, the last thing that you should do too is have an actual description so you know exactly what has happened for this specific transaction, right? And how you're able to do that, right? Your description is not strictly only your account name. As long as you have parentheses over them, that is your description. And it could be as long as you want, as long as you have those parentheses. It could be italicized, they could be in bold, they can be in capital letters, as long as you have parentheses around them for your description. And that's how you properly journalize each transaction. Okay? All right. Any other questions? Okay.
Oh wait, what method of correcting would you personally recommend using? Like, what is your go-to method when you correct?
Okay. For me personally, I would use the reverse and re-entry, just because that way it minimizes the mistakes that you can make, because you're looking at a mistake that already happened, right? The best thing to do is just to undo the mistake and then re-enter it for the correct amount. Okay? That will prevent you from making any further mistakes. Whereas the error cancellation, right? You're determining the difference between the two. So the difference between the two is $9. Now you have to really think about it. Which account is over and which account is under? Or which account is in that position, right? And did I put too much money in my office supplies, or is my office supplies too less? And that's where the common mistakes can happen, because some people might do this too quick and be like, I'm missing $9, so they might accidentally put the cash first. Okay, meaning I'm increasing my cash when in reality I spent $9 more of cash.
Wouldn't that only work on like a spreadsheet though? How would that work? How would you do a reverse and redo on like the actual paper?
So in this case, right, when you actually take a look at a real journal, right? So it's like for example, you open up a notebook, a ream of paper, right? How many lines do you have on that paper?
I mean, you have a lot.
You have a lot. So therefore, that's how you would do it. You would just
Okay.
record it exactly like that. But you don't go back to that same page where you originally wrote your mistake. You just continue on your book as if it's a new transaction, but you're actually fixing an old transaction.
So would you rip that old transaction out or
No,
something like that?
no, absolutely not, because that goes against the rule here where you should not rip out, tear, erase, black out, white out, scratch out, never for a journal transaction, because that's going to make it seem like you're hiding something. You're intentionally frauding the business because you're pretending a transaction doesn't exist.
Okay,
So,
but how would you so what if someone else looks in the journal and they see that you made that mistake on the first one? What if they assume that's an actual transaction or something?
if that's why if you're the bookkeeper, right, you usually can have your accountant go over it, and if your accountant catches that mistake, then they can let the bookkeeper know that they made the mistake, because at the end of the day, you need proof of the transaction, right? You need a copy of the receipt to prove that a transaction has happened, right? That's your proof. If that doesn't match what you wrote in your journal, then that's where the error comes to play. So in this case, if your accountant is double checking the bookkeeper's work, then yes, they'll be able to find that mistake and tell the bookkeeper you need to fix it.
No, but I'm saying like, so say you made the mistake, you caught it yourself, and then you already did the new entry. Now, what if the accountant looks in the journal and stuff, and they don't know that, oh, that first page was a mistake. So how would they know whether it was a mistake or not if you can't cross it out, you can't white out it? How would they know it's just not
Okay,
going
so
through that?
in this case, right, when you do your correcting entry, look right here. My description says to correct the entry that was made on September 15th. So you do
Oh,
have to reference it. Yes, absolutely 100%.
okay, that makes sense then.
Mm-hmm.
That's fine.
Okay, all right. All right, any other questions? Okay, so let's go ahead and do the exercises, okay? All right, so Chapter 3 exercises. Number 1, what is the chart of accounts?
It organized and coded a list of all the individual accounts in the general ledger. No?
Go ahead. No, that was correct.
Oh.
I'm thinking away how okay, so it's say they got a list of
All the individual
all the accounts
in the general ledger.
Okay, good. And you use the chart of accounts for you to create your journal transactions in the general journal. Okay, good. Again, the answers will have the full true length answers here. I'm just doing this for the sake of the class. All right, so what is a general journal?
It's a accounting record that
Okay,
is used to record the different type of transaction.
okay, you said an accounting.
Record of transactions.
Now, what kind of transactions? What do you,
Business transactions.
business transactions, but what is the sole purpose of it? What are you, when you were using this book to record business transactions, how are you recording it? So it's an accounting record that helps record daily, right? Business
Oh,
transactions.
yes.
Yeah, right. You want to do it as a journal for you to keep track of every single transaction.
It's a diary.
Exactly. It's a business diary. Good. Okay. What is the general ledger?
All of the account in their entire entity.
Mm-hmm. Okay, so I'm going to say a book with all of the accounts. But what's the purpose of creating a general journal? And creating a general ledger.
To see the balance.
Good, right? It's a list of all of the accounts with their respective account balances, right? Where your journal is just your daily transactions, where you're just recording, right? I spent this cash, I spent that cash, I spent that cash, right? That's the journal. Now your ledger is going to say, this is how much cash you have, right? And if you spend this cash, now this is how much you have left now. And then if you spend more cash, this is what you have now. So that's the difference between the ledger and the journal, is they are exactly identical. The only difference is that you're going to have a record of every single account that has their account balances, and that's the ledger. Okay?
I have a quick question.
Mm-hmm.
Is there usually one general ledger for a business, or is there multiple general ledger for different account
No, 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 no.
for
There's
the
only
business?
one. There's only one general journal. I mean, sorry, one general ledger.
Okay, so
Okay.
one general ledger shows all the account balances.
Absolutely, yes.
Okay.
Mm-hmm. And for a business, you can have multiple general journal books because they, business could be split up in different areas, right?
Yeah.
Okay. Number 4, what are the 7 steps of transaction analysis? What do you need to do first?
First, we need to recognize that transaction has occurred.
Yeah, recognize the transaction. Okay. What's step 2?
Understand how that transaction affects the business.
Okay, understand how it affects business. Okay. 3.
Determine what accounts are affected by that transaction.
Good. Determine which accounts are affected. Okay. What else? Step 4.
And then, number 4,
Mhm.
use the business chart of account to determine which account number that represents the account.
Good. Use your chart of accounts. Step 5.
We use the debit and credit rules to determine if the accounts are debited or credited.
Good, right? Using your debits and credits to determine, right? So that's where your accounting model is going to come to play because then that will give you a better understanding, right? How are you going to debit or how are you going to use a debit for the specific account and how are you going to use a credit for the specific account, right? And then number 6,
Determine what journal should be used to record the transaction.
okay, which journal? And last but not least,
Record the transaction.
do it like the Nike logo. Awesome. Okay. Record it in the book. Number 5, how is the general journal recorded in terms of time?
Chronological, use that the word?
Yep, chronologically. Yes, it must be recorded in order by date. Chronologically. Okay? It must be in respective to the time and date, right? You have to record the dates in order. Right? Number 6, when recording a general journal, what goes first?
Debt.
Yes, your debits go first. Yes. And debits go first. Okay. And of course, that means your credits go last. Okay. Number 7, okay? At the end of journalizing, what must be true?
Debit equal credit.
Yes, your debits must always equal to your credits. Okay. And then number 8, which 2 methods, what are the 2 methods for correcting journal entries? Yes.
Reverse and reentry and error cancellation.
Good. And error cancellation. Good. All right, so this is where we're going to be practicing the transaction analysis, okay? So, question number 9, based on the following transactions in the general journal using the chart of accounts. So, we're going to use the chart of accounts. So, here We got your assets first, which is your cash, your supplies, and inventory and equipment. You have a liability called accounts payable. You have another liability for loans. You have equity. You have sales, cost of goods sold, which is an expense, and you have your rent expense. And then they all are coded with account numbers. So this is your business chart of accounts. So what we're going to do today is practice the 7 steps of transaction analysis. So here are a couple of examples that we're going to be looking at, and you need to use the transaction analysis to determine how to record this transaction. So starting with the very first one, date is January 1st, and you paid rent for $500 cash. Okay? So step 1, we determine that a transaction has happened. Yes, it has. Step 2, we need to understand how does this affect the business. Well, I purchased rent, or I paid for rent. That means that's part of my operations. So yes, it affects my business. So step 3, right? Determine which accounts are being affected. Well, I paid for rent. So in this case, do I have a rent account? Yes, I do. I have a rent expense, right? Account number 660, right? It's an expense. How did I pay for it? How did I pay this $500?
Cash.
With cash. Do I have a cash account?
Yes, 100.
Yes, cash account number 100. So, step 4, which is determining using your chart of accounts. Do you have those accounts? Yes, you do. Step 5, debit and credit system. Okay? What did I do?
So we spend the cash,
Okay.
and then we also, oh, wait. So we expenses, then expenses debit
Yes.
increase.
Because we purchased rent expense, right? We gained rent, right? So therefore, we're going to debit the rent expense. What about my cash account?
It's an asset decreased.
Right, because we spent the money. We don't have that money anymore, so we decreased it. So therefore, I'm going to... what am I going to use?
So we do a rent expense first because it's a debt.
Okay, all right. So first things first, we got to write our date in. January 1st, okay? We determine rent, right? So we're on step 7 now. So we determine that rent's going to come first, okay? Rent expense, right? What account number was that? 660, okay? We determine that's going to come first, okay? Then
We put 500 in debit.
correct, because we spent 500, so we gain $500 worth of rent, okay? And
then we
indent, good.
and then write cash.
We have the cash account, good,
And
which
then
is account number,
100.
good. And how much money did I spend?
We put 500 in credit.
Yes, we spent $500. Now, it's optional. You don't have to put your description unless you want to, but you can say that you paid rent, right? But I want you to practice just understanding, at least getting the accounts in there. But I'll go ahead and throw in the description anyway that you paid for rent. Okay? Straightforward. Okay? So scenario number 2 says that on January 5th, you end up purchasing inventory 100 items for $1 each with cash. Okay? So, what did you do here?
We did it's expense again.
Let's take a look at my chart of accounts. What account would I use for...
But we gain the inventory.
Is inventory an expense?
No.
Okay. Right? We bought inventory. That means that inventory is mine. So therefore, what did I do?
Well, only expense of the inventory is equated in that chart of account. Oh, no, wait. Cost of goods sold.
What is inventory?
It's an asset.
It's an asset, right? Because we own when we purchase those inventory items, we own it, right?
Yes.
So we determined it's an inventory asset.
Yes.
So since I purchased inventory, did I increase or decrease the account?
We increased
We
the
in
debit.
good. Okay. Now, how did I pay for it?
With cash again.
I spent cash, so therefore another decrease in my cash account. Okay.
Yes.
So good. So let me see. It's January 5th. We bought some inventory. Account number, what was it? Account number 150. Okay. We spent cash to purchase the inventory. Okay. Now, how much money did I spend to buy inventory? Okay. I bought 100 items for $1 each.
Oh, $1, $100.
$100, right? You can't just pay. You can't put. I bought 100 items, right, for $1 each. What's the grand total that you spent? You spent $100, right? Right? And that's it, right? And your description can say, right? You purchased inventory items, right? Or you purchase inventory 100 items, okay, at $1 each. Okay, right? That would be a perfect description of why you spent $100 for inventory, because at this case, right, when I look at this, I know that I purchased 100 items. Okay, good, right? Then January 8th, you end up purchasing a machine for $750 cash. Okay, I bought a machine for $750 cash.
That's a equipment asset.
Correct. It's a equipment. Did I gain the equipment or did I?
Yeah.
Okay, good.
Yes.
So I would debit, right?
Yes.
All right. And how? What's my other account?
So we also use cash to pay for it. So it's another asset that decreased.
Good, right? We're going to decrease it using a credit. So equipment is 160 and cash is 100 for January 8th. So that's the first thing we got to do. We determined that we acquired equipment, okay? And we paid using cash, okay? Okay. And how much did I spend? How much money did I spend on this machine?
It would cost us $750.
Cost us $750. So therefore, I'm going to decrease my cash by $750, but I end up getting a machine for $750. So in this case, I'm going to say I purchased a machine. Okay? Do not put how much the machine costs, because that's going to be redundant, right? Because you already put in right here that you bought equipment for $750. Now, let's say you bought multiple machines. Then yes, you can go ahead and list them out how much they each cost. But at the end of the day, that's what that you should. I mean, you can. It's just redundant to do so. Okay. So I don't have to say I purchased a machine for $750, right? If I just put I purchased a machine, I already know it's for $750 because I spent $750 cash. Okay? All right, so let's see what happened next. On January 10, you purchased supplies for $56 on an account. Okay? So, here's some terminology that is new. We purchased supplies on an account. What does that mean?
We asked them to bill me later.
Correct, right? Because we said we have an account with them. They said, great, you have an account with us. Your account balance with us is, X amount of dollars. That's your credit limit. So you can charge as much as you want, and we will bill you how much you owe me for you to pay me back later. So therefore, what account would that be?
Credit, because yeah, it's credit.
It's a credit account, correct, but what account name? Or in this case, what account type am I looking for?
It's a liability because we owe them money.
Correct, right? We bought the supplies and we didn't pay for them. We told them to bill us later. So it's a liability, right? We owe them money. Now let's take a look at my chart of accounts. I have two liabilities. Is buying supplies on an account going to have me pay a year later from now?
No, it's a current account. Current.
It's a current liability. So in this case, it's definitely not a loan, right? You don't owe them money for borrowing money, so it's definitely not a loan. So in this case, what account do I actually have left? I have an accounts payable, right? Because that's the only liability account that I have on my chart of accounts. And accounts payable is when you owe money to your vendors, okay? Typically 30, 60, 90 days, okay? So that's where you would put it, would be accounts payable for your liability. Now, what did I buy?
You bought supplies.
I bought supplies. So therefore, did I increase my supplies or did I decrease my supplies?
Because it's an asset, it's a debit increase.
So we debit or increase. Now, since I owe money to this vendor, right? Did I increase the money that I owe or did I decrease the money that I owe?
We increase the amount we owe.
So how do I increase a liability?
By putting credit.
There you go. So that's exactly that's correct, right? So on January 10, okay, we purchased some supplies, okay, for $56. Okay, supplies, what account number was that? It was 110. Okay, and we purchased it for $56. Okay, and we placed it on an account, which was accounts payable, right? It's a liability. We're increasing our accounts payable by $56, right? Because we said we're increasing it by crediting the account. And I'm going to make a note here. Purchased supplies on account. Okay? Usually you'll have the vendor's name on there. Okay? So you know who you owe. Okay? Then on January 12th, okay, you had a cash sale of 25 toys for $5 each. No sales tax. So here I have a sale. I sold 25 toys for $5 each, okay? And they were cash sales. So, how would I understand this transaction?
So we gain the cash.
Yes, we did.
And then we also made a sale.
Correct.
So the cash increased.
Okay.
So it's a debit.
Good.
But we also, because we have to balance out, we just say credit on the sale part.
Well, okay, but take a look at your accounting model, right? How do you
Yeah.
increase a revenue?
By credit.
There you go. So therefore, that's exactly what we're going to do. We're going to, let me see, good, enough space here. It is January 12th. We received cash, right? And we earned a sale. Okay, so cash 100, sales is account number 410. Okay? And how much money did we receive from the sales? Okay, if we sold,
125.
good, right? 25 toys for $5 each, you gained a total of $125. Okay? Okay? And of course, you can make a note saying here that you sold 25 toys, right, at $5 each. Okay? So that's why you got the grand total of $125. But in this case, your company should already know what your sales price is, so you don't actually need to say that I sold X amount of toys for a specific price, right? Your store should already know that. Okay, let's continue on. I'm gonna add a few extra lines here, okay? So let's see, on January 12th, once again, same day, you need to adjust your inventory to for the cost of the items, okay, that you sold, okay? Right? Because I end up getting rid of my inventory, so I need to adjust my inventory because I just sold 25 toys. How would I record that?
We decrease the inventory,
We're decreasing inventory, correct?
but we increase the. I don't know what we increase.
So in this case, right, we're adjusting our inventory, right? Because we
Yeah.
need to know how much it cost me to sell my inventory. Okay?
Cost of goods sold.
Cost of goods sold, right? Because in this case, right, how much did it cost me to get rid of my inventory? That's the question. That's why you have to calculate the cost of goods sold. We're getting rid of our inventory because we're expensing it, right? So in this case, now, if you use the debits and credits rule, right, expenses are usually increased with a debit, and you already figured out that you're decreasing your inventory. Okay? So therefore, that's exactly what we're going to do. It's January 12th, right? We have the cost of goods sold, okay? And we're going to adjust our inventory. Okay? So inventory was 150, and let's see what cost of goods sold is. Cost of goods sold is account number 600. Okay? So now let's go ahead and figure this out. How many items did I sell? Okay, in this case, how many items did I sell from the previous scenario?
25 toys.
25 toys, right? Now, how much did I purchase my toys for?
$1 each.
You bought them for $1 each. So in this case, how much did it cost you to sell all 25 items?
$5. No, $25.
$25 because they cost you $1 each. So in this case, we're not going to talk about profits. Okay. because we gain a huge profit off of these ones. Okay, so in this case, right, it cost me $1 for each inventory item, and or in this case, toys, right? And I sold 25 of them, so that's going to indicate that I sold $25 worth of inventory. Okay, and I can go ahead and say sold 25 toys. Okay, at okay, and then you can say cost $1 each. Okay, it doesn't matter. You don't even need to have this either because we'll talk about inventory in chapter 5. Okay. All right, last one here is going to be January 15. You borrowed $5,000 from the bank. Okay.
So we gained a loan.
We gained a loan. Right, we borrowed money. Okay.
Yeah, we borrowed the money.
So how do you increase a liability?
We credit.
Good. Now,
So
what do you get when you borrow or take out a loan?
we get the cash.
You get the cash. So in this case, did you increase your cash or did you decrease your cash?
We increased the cash
We
amount.
increased our cash. So there you go. You got a loan for $250 and you got cash for $100, or account numbers. Okay. So in this case, it is January 15. We increased our cash and we increased our loans. Okay. By how much?
$5,000.
Yep, there you go. All right. And, right, this is self-explanatory. You took out a loan. Okay. Excellent. Good job, guys. So that's good practice. Now, this doesn't stop here, right? This is going to carry on from the rest of the course because you're learning how to bookkeep. So that means from here on out, the lessons that we're going to be learning is going to be practicing journalizing and why we use specific accounts. And then at the end of the 5-week course, at the end after the 10 weeks, right, we're going to dive into a class project where we're constantly going to go follow a business and we're going to practice bookkeeping for that entire month. Okay, so good. This doesn't stop here because we're going to continue keep practicing over and over again how to journalize. Okay. All right. So let's finish up the next couple minutes here. Number 10, okay, using the transaction on January 10 from above, you recorded that the supplies were $56 on January, $56, okay, comma. On January 20th, you realize there was an error in, of course, that the supplies were actually for $65, okay? So now we need to record this error that using both methods, okay? So first we're going to do the reverse and reentry first. So in this case, right, we have proof that right here on January 10, we purchased the supplies for $56. But in reality, it says that on January 20th, we realized we recorded it for the wrong amount. So this is us going back through our journals and we're like, oh wait, hold on, this doesn't look right. So that's where we find out that on January 20th, we need to do a correcting entry. So in this case, the first one I want you to practice is the reverse and reentry. So if I purchase my supplies on an account, okay, how do I reverse this?
We have to undo the transaction that we did on that paper.
Okay, so how do we do this?
We put cash.
We didn't pay it with cash.
Oh, no?
So the transaction was we purchased the
the
supplies
yeah.
on, okay, yeah, good. So how do I reverse this?
So we write the account payable in debt for $56,
Mm-hmm. And then,
and then we write the supply for a credit for $56.
okay? And your job to do here is to correct the, actually, no, because you're just reversing it. Okay, so then what's the next one?
And then we write the office supplies.
Oh, in this case, it's just supplies. I added the office by accident, so supplies. Okay.
And then we say $65.
Right. We enter it in for the correct amount of $65.
Yeah.
And this is where you can go ahead and type in to correct the error on January 10 entry. Okay. Good. Okay. Let's go ahead and quickly practice the error cancellation. So if I decided to choose the error cancellation method, how would I fix this error?
You write the account payable.
No.
No. No.
Okay. What's the first step? Okay. What's the first step when we're looking at error cancellation?
We are finding out the difference.
Correct. So in this case, it's supposed to be 65. What did I originally record it as?
56.
So what's the difference between 56 and 65?
$9.
$9 difference. So that is it. I am missing $9 somewhere. Okay?
Yes.
So now the question is, my original journal said I had 56, but in reality, I need to have 65. So
Yeah.
which account is over and which account is under? Am I over in my supplies? Am I $9 over? Or am I $9 less?
I can see the account payable supposed to have $9 more.
$9 more.
Yeah.
So how do you increase an accounts payable?
It's a liability,
Mm-hmm.
so the credit increase.
Good. See, you already made your first mistake right here because you said accounts payable goes first. You would have subtracted $9 from your accounts payable.
Yes. Oh, okay.
So that's why for this kind of case, right? Sorry. For this kind of case, I would make another error trying to fix my first error.
Yes.
Okay. So now I'm missing $9 in my accounts payable because I'm supposed to pay more. I'm also missing $9 in my supplies. Okay. All right. And then once again, to correct the error on January 10 entry. Okay. All right. And that is it for today. So, good job. Any questions, I'll post the answers to this in the same exact folder where you found these exercises. But any other questions in regards to chapter 3?